Hi, it's Amar. Today I'm going to show you how different accounts are taxed and how that makes a huge impact on retirement. So let's get started. So I'm sharing my screen now, and what you typically have is three basic accounts. And your first account here, sorry for my drawing, is money comes in after tax. So this is a taxable investment account. Typically, you pay 1099. You get 1099 every year for interest and dividends. And when you sell something from this taxable account, so this is called a non-qualified account. So think about a joint account, individual account, trust account. These are all non-qualified. When you sell something, you pay a capital gains. And that capital gains can be either short-term, which is taxed at ordinary income, or it can be long-term, which is capital gains rates, which tend to be more favorable. The second type of account that you can have is like a 401k, a pre-tax 401k, or an IRA, 403b, 457. Dollars come in before taxes. They grow tax deferred, meaning you're not getting a 1099 or any tax documentation on an annual basis. But when you take money out, 100% is taxed at ordinary income rates, right? So the difference here in a non-qualified account is only the gains are taxed at ordinary income when it's short term. Here, it doesn't matter if it's short term, long term, whatever. Anything that's coming out of this bucket is taxed at ordinary income rates. And then we have a third bucket here, which consists of Roth IRAs, sometimes municipal bonds, but Roth 401ks as well. Dollars come in after tax, just like after your paycheck. After you get your paycheck, it's the same as here. They grow tax deferred, the same as your 401k, your IRA, your 403b, your traditional plans. But when you take money out, everything is tax free. So the biggest benefit here is that not only your dollars going in, they've already been taxed, you get taxed up front, but those dollars coming out don't get taxed again, and the gains in those investments are tax free. So really, when you're doing retirement planning, you want to structure your plan to have all three of these buckets. And so that way you can itemize or you can decide which buckets to withdraw from to really maximize the tax brackets. And I'm going to give a couple examples of that right now. So I'm going to clear this drawing. And so again, the benefit of that triangle is you're putting dollars in. If you put it in the Roth account, this gain, right, this is your money, but this gain is also tax-free, right? And you're taking your basis out, obviously tax-free. So that's the big concept of the triangle that I want to hammer home. But the idea that, let's say you have 100,000 of lifestyle expenses per year, if you were to take this all out of the IRA, the pre-tax bucket, you probably have to withdraw close to 130,000 because you have to pay 30,000 in taxes. Okay, and this, I live in California, so we're talking, California state tax and income tax, just for illustration's sake. The other option is that if you took 50,000 out of your pre-tax bucket and you took another 50,000 out of like the Roth IRA bucket, you have the same lifestyle, right? These two lifestyles are the same, but here you're probably going to have to withdraw maybe 62,000 because you're in a lower tax bracket. And so you get $12,000 tax bill versus 30. So that difference is roughly 18,000 per year that you can save on taxes. And both of these individuals have the same lifestyle, right? Now, this person paid some taxes in the beginning that's not included in this kind of equation, but when you're doing these tax strategies, you want to make sure that you have a proportional amount in each one of these buckets so that you can decide where to pull what funds. And and so this is a big piece of retirement planning, because even when you look at Medicare Part B expenses, your income aren't required minimum distribution could push you over that amount. And you may be better off doing Roth conversions earlier to stay below a certain threshold. And so this is why having an approach that's spread out amongst all these three gives you that flexibility and control. And if you have any questions, or if you want to work with an advisor that's integrating your investments with your taxes and estate planning, please reach out to us. Thank you.